Welcome everybody to our live financial Q&A with our friends from, well, we call them the Solvers. They're friends from Solve Accounting. We're going live right now on the Solve Accounting YouTube channel and also onto the ET Stand channel as well, because the Solve Accounting guys are sponsors of my lovely channel. We've got Phil Cow and Jono Wilkes joining us. Today we're going to be discussing some of the biggest financial topics currently being talked about following the announcement of the federal budget. So you can actually ask us questions live in the comments. We've already had one person ask us a question. Belinda Middleton has asked us a question there, and we'll bring it up like that and talk to that question. So you can do that on the right-hand side of your screen in YouTube. You can hit enter the live chat and ask us a question, and the boys will answer the questions. There's obviously been a lot of headlines, a lot of confusions. I said, Phil, we needed to do one of these videos. I said, I wasn't sure. And then the announcements came out, Phil.
Yeah, I'm like, we need to jump on. There's a lot going on, lots of changes. There's an uproar really from the public and our client base. So I think it was needed. So thank you for, taking time out to do this for us and to help us here.
Indeed. Jono, you've already been helping me, mate, actually, with some of my questions and queries. So if you do need help from the team at Solve, the link is in the description for this channel. You can click on that and book a meeting with the guys. Jono, g'day. Good to see you, mate.
G'day, Dave. Thanks for setting this up for us.
Pleasure, mate. You guys sponsor my YouTube channel, so it'll be amiss of me not to do that. And it would be amiss of us not to comment on our dear friend Chris Bloxham. Phil, why don't you comment?
Yeah, that's right. So, everyone that knows us, Solvers, we are missing an integral part of Solve. Chris Bloxham, he sadly passed away in December. We definitely miss him. He's a brother to us all. And look, I wish he was here, because I'd love to see his reaction. He'd be rolling in his grave right now with all these changes here, and he'd be kicking up a storm right now about it. So, but alas, he's not, and we'll try our best to do that for him.
That indeed we will. He's just realism, and I think it's just the DNA of his setup is certainly in throughout your system and your business, Phil and Jono. So, yeah, we do miss him.
He definitely left his mark. So.
Yeah, we definitely miss him a lot. All right, let's get into it. Capital gains tax, Jono, was where we're starting with today. Also, before we get into that, so we're chatting capital gains tax, then we're doing the discretionary trusts, then we're chatting through the negative gearing. So they're the three big topics that we're giving you guys today that we're going to go through. So if you've got any specific questions, again, do get them into the comments. We've got one from Belinda Middleton, 1207. On discretionary trusts. So we'll see if anyone can beat that question. And I hear that best question in the YouTube channel, Phil, is getting a free Solve Accounting mug.
Yeah, that's right. They are. It's an exclusive mug, one of one. It's not made yet. It's in progress.
Sounds good. All right, Jono, give us the rundown. The capital gains tax. What is it? What's it for? How's it changed? And how are you thinking about it? What's your reaction to that part?
Yep. So capital gains, so it's been around in Australia since 1985. So when you buy a capital asset, whatever it is, shares, crypto, nowadays, real estate, you're going to pay tax on the increase in value over time. One of the best concessions that's been around is the 50% discount on those gains. So under the current law, well, it hasn't been amended yet. You can basically, if you made a gain of 100,000, you could reduce that by 50%. You only pay tax on the 50K. So basically, what the budget has said is from 1 July 27, that discount is going to be removed. And we're basically going back to 1999 rules, and under those rules, there's no discount, no 50% discount. Instead, there is an adjustment to the cost that you bought the asset at to adjust for inflation. So that's what's happening to the calculation of the gain itself. On top of that, there's also now a 30% minimum tax on the capital gain. So those are massive changes to how capital gains are taxed. Australia will now have one of the highest tax rates on capital gains there's other countries around the world where they don't tax capital at all. Even our neighbours over in New Zealand don't tax capital gains. So yeah, this is a massive change. It will probably mean more tax for people who invest their wealth, who are able to invest in crypto and other assets, real estate, shares. So yeah, that's
what's really important there, Jono, for our listeners is that it's not just for property; it's for all asset types, as you alluded to earlier. So shares, cryptos, any assets really outside of other than property it's all captured under this change. And I think the other thing to highlight before we move on to the next point is the changes are from 1 July 2027. So realistically, it's going to really hurt those that are looking to invest post that date. I think if you already have investments, whether it's in a property, shares in a business, shares, cryptos, whatever it may be, prior to that date, you would still have access to the 50% discount. But then obviously you would have to transition that depending on when you decide to sell that asset. So really, I would say the loser here, or the losers here in this change would be new investors. Post 1 July.
What does that mean for me with, I don't know, I've got 50 grand in shares, Phil, in, let's call it Macquarie Group. And I can see they're doing okay at the moment. Does it change how I think about that? Should I be trying to buy more before this date cut off? How do I think about that?
Question. I think you definitely should be thinking about restructure, but I'll let Jono answer this question. This is more up his alley.
Thanks, Phil. Yeah, I mean, it's something that, you'd look at very, very closely in the next 12 months, because you might be better off selling some of those shares. If you've held them for more than 12 months, you might be better off selling them prior to 1 July 2027. So you've got 12 months to look at that and make the decision. You probably run some numbers on and do a bit of planning around it to see is that going to be better for you. The other thing to note is that even if you held on to the shares, you're still going to have your discount up until 1 July 2027, and there'll be a market value at that date, and it's only the increase in value after that date. So from 1 July 2027, that would be taxed under the new rules. So I guess what I'm saying is you wouldn't necessarily lose your discount on those shares, such that you had to sell them. You'd still have the benefit of the discount. It'd just be more complicated if you sell them post that date.
Do you have a view on how that's gonna impact the share market, Jono, then?
Look, how it's going to impact shares, I mean, I think it's hard to tell, but there's probably going to be around that date, I'd say there might be some distortion in market. I guess we'll have to wait and see what investors do. Again, they might be looking at, and we'll get into more detail, but they might want to restructure how they own the shares. So they'll still hold on to the shares, but maybe they'll try and structure them into their super fund or self-managed super if they have one. There's also the option to hold passive assets in companies as well, which we'll get to when we talk about trusts.
So the
my initial thoughts, sorry, David, my initial thoughts is that because the budget's just been announced, so a lot of this stuff, the finer details haven't been released yet in terms of how it's all going to work. So I would say a lot of right now, the short term, there's going to be a lot of sit tight and wait to see what happens. So I don't suspect a lot of activity will happen in terms of buying and selling over the next few months until we have more detail as to how this will all work. That's kind of my reaction in terms of the short term for investors.
Does it strengthen the concept and product of self-managed super, Jono?
Yes, I think so. It definitely, I mean, that's kind of the last tax concession, well, apart from the family home now. If we're taking away the tax benefit of trusts, really, we're taking away the benefit of holding capital assets in trusts and individually. Yes, the discount will remain in super. So if you have a self-managed super fund or just a standard industry or retail fund, the capital gains discount will remain in those vehicles. And obviously it's a different, slightly different, because it's only a 1/3 discount in the super fund environment. However, yes, I think so. I think so that, you know, the super is going to become perhaps even more important after these changes.
I don't like it. I don't like it at all. Yeah, I feel the same, Jono. It is getting pushed that way in terms of, you know, how we should really, which entity we should really be investing in to get the best tax benefit out of, to get the best tax benefit. But ultimately, you know, the disadvantage of super is the fact that you've now locked your cash away until you retire. You know, and there might be a lot of, you might have a big balance then, but you might be too old to do anything, and you might even pass before you actually get to that age to see any of that cash. That's one thing I kind of hate about it, if we're now shifting towards super, right? And then the other thing probably to consider for those that are really into the superannuation or self-managed super funds is the $3 million cap. In terms of,
so explain the $3 million cap to us, guys.
Yeah, so if a member's balance is over $3 million, anything over that balance is then effectively taxed an additional 15%. And so it's not, it's now at 30% in terms of any value over $3 million. So you lose that benefit as well, having a dollar over $3 million. Yeah. I think at this point it's not. I think at this point it's not indexed as well. Is that right, Jono? The $3 million balance.
No, I think originally there was going to be no indexation of that threshold, but they changed it after feedback. Obviously, people screaming about it, taxing unrealized gains and so on. So they've now wound that back. But I guess what I don't like about the capital gains changes as they've been released in the budget. Well, it's still going to penalise people who have a small business or any business, you know, that they start and they build up over time, and then they look to exit that in future. Yes, there's still small business CGT concessions, but they can be pretty complicated to get into sometimes. So this is taking away, you know, an easy concession to apply the 50% discount. So that's one thing.
Yeah, it feels like. Sorry, Johnny, you go.
Sorry, just the other one I was going to rant about was they're now going to start taxing pre-CGT assets. So CGT came in 1985, and up until now, if you sold an asset you owned before that date, September 1985, there's no capital gains tax at all on that. Now, any increase in value from 1 July 2027 will be subject to these new capital gains tax rules. So that's a fundamental shift, and you know.
Does it mean my parents, Jono, their home at Cronulla that they've owned prior to 1985, if they need to sell that to move to a different location, because obviously living in a home is difficult for them, they're now going to get taxed on that in a way. Geez, that's a bit tough, isn't it?
Well, there's still the main residence exemption.
So they're out of that one. So that doesn't touch that one. So, okay.
Yeah. As long as they lived in it and, you know, they meet all those other rules, it's their home, they're not going to get taxed when they sell it.
Yeah, got it. I guess that's why there's the fear around all this sort of stuff. We've got some comments coming in, guys. I'll pick those out when we get to the individual moments. If you've got any questions for the solvers, we will certainly answer this. So so you guys have obviously been dealing with some of your clients' positions so far, talking to the capital gains tax. Can you share us, you know, a scenario that someone's in and a piece of advice that you've given? And so give us a more standard
Yeah, Jono,
in this
we've
position.
got an example to show the audience, but as Jono gets that open, I mean, I'll rant a little bit. It just feels like this budget from the government is talk about giving fairer opportunities to everyone and intergenerational wealth. But I just feel like with this CGT proposal, it feels like they're disincentivizing people to actually invest in shares, in assets, in businesses. What's it going to look like for the future generations post 1 July 2027 that actually want to do these things? They're effectively going to be taxed at least at a minimum 30% on sale of those assets. And if they're held personally and they have a high marginal, high income, they'll be taxed at the marginal rate, which potentially could be almost 50% of those profits when they sell that business or any other asset. So that kind of really peeves me off a little bit because it just really contradicts what they're putting out or the aim of the budget, right? To give everyone a fair go, to help build intergenerational wealth. But by doing this, it's not really helping. It's disincentivizing people to start something and build something for themselves. So I really, really hate that one.
You've got to, well, I think the sentiment largely is not popular. And look, we understand the frustration that everyone's there, but hey, guys, we're solvers. So I'm just going to steal an analogy. We're not problem focused. We're going to work out what's the best strategy to actually solve for some of these problems. So do you want to give, Jono, do you want to show that example?
Yep. You got my screen?
Oh, yeah, I can do that. I have to press. Hold on. Yeah, hold on. I need to just press the type here. This is letting you guys in behind the curtain. There we go. Hold on, I'll edit that up. I'll just move that over for you, Jono. There we go.
Yep.
Hold on a tick. This is how good this is, just editing on the fly.
You're too good, Davo.
Oh, mate, I'm all right, but that should have worked straight away, unfortunately, but it didn't. So,
there you go.
Yeah, no, here we are. All right, let's go through it, Johnny. Got to love a screen share.
This is our first YouTube live, so I think we're doing all right.
Oh, we've got 16 viewers right now at the moment watching us live, and shout out to anyone who's watching us later. So talk us through this one, Jono.
Okay, now, disclaimer, this is a pretty simplistic example. So I'm just comparing what would the tax be on 100 grand capital gain under current rules, so that's the box up here, and under the proposed rules. So, and for each of those scenarios, we've got someone with no other income, so just this 100 grand gain, and then 85,000, so kind of a middle income person, and then 190,000. So we can see if we look at the current tax law, $100,000 gain, the taxable gain is only going to be half under the discount, and then there's tax on that. So we can see here 6,700 if that was their only item of income, 16,000 if they're on the sort of a middle income bracket, and 23.5 if they're on the top bracket. So then we go to what would it be under the proposed law. Again, this is simplistic, so there's no indexation in this calculation. But just to illustrate, 100,000, no other income, minimum tax 30%. So straight away we can see there's 23 grand of additional tax for the person with no other income. That's a lot. 85 grand, a middle income person, they're going to be paying an extra 19.5, almost 20 grand. The wealthy top marginal rate person, 190K or more, additional tax of 23.5. So you can see that's making a massive impact at both the top level and at the bottom level. So that's
one thing I'd add to that to the listeners is the CGT reform here. It exempts pensioners and low income earners. Okay, so the minimum 30% tax won't apply to those type of taxpayers.
That's right.
So Mitch White in the comments has asked us this question. So with the new indexation method, can you explain for the layman how it will compare to the 50% CGT discount under a scenario of high inflation going forward versus low inflation? So I guess, yeah, with that, what you've explained there, I think does a pretty good job of that. But through the lens of inflation, how does that change what we're thinking?
Yeah, so it would change. So under this scenario, we've just worked out the capital gain. So it would change this number here, these numbers, because let's say you sold something for 200,000 and the cost base was 100,000 in dollar terms. Let's say you hold it for 5 years. There's inflation each year. Your cost base would go up to, let's say, I don't know, 125,000. Then the gain would reduce to something like 85 if we're indexing the capital gain, and then you work out your tax on that at your marginal rate.
So how does someone sitting at home calculate these indexes and do all these things for this stuff if they are selling these things? Sounds incredibly complicated.
Yeah, look, if I think back in my accounting career, I started in 2008, and I remember doing calculations, applying the index, because you used to compare to see what gave you the best tax outcome. Like, you had a choice when they brought in the discount. So there'll be some form of calculations or calculators on the market. There's tax software that will help with this. I think the layman, will be able to get access to those, either themselves or with the help of an accountant using their tax software. I think the main complexity will be if there's a split period gain, discount before 1 July and then indexation thereafter. You're almost going to have to do 2 capital gains calculations. That's where it's going to get a bit more complicated, I think.
Okay, so to close it out on the capital gains tax for us, guys, and Jono, maybe you can give us your main summary, and then Phil, give us your top line. For the general Australian, what should we be looking out for, and how should we be thinking about this change?
Yep. Well, I think plan ahead for the next 12 months. How you structure your passive asset, whether that's shares, crypto, property. You're probably going to be looking at something like an investment company, private company, or seeing what you can do with super or self-managed super, if you have one of those. That's how we're going to best be able to deal with this, because as you can see, there's going to be plenty of additional tax on capital.
Yep, I agree, John. I think that my main thing would be to definitely consider a company moving forward to invest, to cap the tax rate at 30%. And the other thing I'd say is, with the main residence still being exempt for capital gains purposes, that's probably one thing or the main thing that a lot of investors will be focusing on now, upgrading their main residence and keeping that intact.
Personal question. I've just moved out of my place and have been living in it for 19 years, and I'm about to start renting it out. So when does it not become my primary place of residence?
So from the date that it is rented out, you have up to 6 years you can choose to treat it as your main residence under the tax rules. So we can keep applying that exemption for another 6 years, as long as there's no other property owned that you want to apply that rule to. We can extend that for up to 6 years. So then if you sold in year 5, even after renting it for 5 years, and it was previously your main residence, we could apply the exemption in full.
Got it. All right. Well, that's why I'm talking to you and work with you, Jono. And for those that don't know, look behind the scenes. Jono has been incredibly helpful.
Not many loopholes left. That's still one of them.
All right. Sounds good. All right. Let's just quickly get through some of these comments. We're going to start talking discretionary trusts, but we'll just go through the comments. Chris in the comments is not happy with the budget. He thinks it will not help new home buyers. Rent will mostly go up due to landlord requirements to cover capital gains tax losses. That's probably right, Chris. We've got to think about who the losers and the winners are. Andrew Wilkner jumps on, says, thanks, guys, for jumping on and doing this. And then he's got a question around family trust. We'll come back to your question, Andrew, in a minute. We'll answer that one at the end of the trust section, guys. Cecil, regular ET stand watcher. G'day, good to see you, Cecil. Driving more investment offshore. We'll talk about investments offshore at the end, and if that's a good idea at the end. And then one disciple, Michael, says, wasn't expecting this stream. Bumblebee tuna. That's a way of saying hello for the uninitiated. I guess there's a whole bunch of angry people as well going on that. Do we want to comment on how people are angry in this stream, Phil, or we wanted to stick to the side?
I think no, we should, because I think if there is an uproar with the major with the public, there may be, and the government may censor it, right, or would censor it, and they may make some changes to the proposed to the proposed reforms. So I think if there is an uproar, continue giving it to the government. Express your feelings, because ultimately, when we look at the political landscape, right, the Labor government have another 2 years in power. They won the last election by a landslide. They've got the majority now. The opposition currently don't have any direction. Maybe they will with this budget reply, but we could see another 4 years of the Albo government, and that's going to mean disaster for a lot of us if we don't act now. So I think the uproar is needed. Keep it going so we can ensure or try and reduce the amount of changes they're looking to make here. Now, interestingly enough, I was listening to the radio today, and I was listening to Angus Taylor, the opposition leader. He did say that he would be repealing the taxes proposed by the Labor government. So, you know, if he's going to push that stance, then there's no reason why a lot of people wouldn't shift to Liberal.
Well, if he goes to the election and says he's going to repeal all of this sort of stuff, and there's a whole bunch of angry people, then you might be better off just to sit there and wait for the CGT laws to change. So then the other problem, you've got a bunch of desperate people that are going to really miss out, and then the people that are able to hold on are going to be okay. It's a really tough landscape at the moment, isn't it, fellas?
Very, very hard to predict at the moment, but let's wait and see. Just keep up the uproar.
All right, well, thanks for joining us. There's a whole bunch of you watching live right now. So if you do have questions for the boys, these questions are great, guys. I'm thoroughly enjoying this. Thank you for jumping on. Jono, discretionary trusts. Quick explainer on what a discretionary trust is, and then what are the changes that are impacting those that have got them.
Okay, so discretionary trust. So it's the vehicle of choice for a lot of business owners and investors, and the reason it's used by those people is to passively hold assets and separate the ownership from yourself. So there might be reasons for doing that outside of tax, like protecting assets. They're not in your name. There's the ability to allow succession within that trust to your family or your children. So a typical structure is a discretionary trust that holds shares in the trading company. So the trading company is the one that's doing the business, the day-to-day, employing the staff, paying its tax at 25%. And then when there's excess profits, that company is going to pay dividends. And the trust allows you, a discretionary trust, it's discretionary because the trustee gets to decide who in the family or what entities in the family get to receive the profits. So that's roughly the idea behind it, and why people have used trusts in Australia for many, many years, and totally legitimately as well, I should add. It's not, you read in the budget papers and the way that Labor talks, it's like, these are kind of scary tax evasion vehicles. I mean, they're pretty standard way to set up your business and hold your assets. There's nothing wrong with it.
So what's changing with the rules, Jono?
Okay, so they're basically going to tax trusts like companies. So the trust, previously, it's a flow-through vehicle. Income comes in and it goes out. There's no tax at the trust level. What the budget is saying is there will be a 30% tax on the income of the trust from 1 July 2028. So that tax will be paid by the trustee of the trust. Basically, it's either a person or it's a company that controls the trust and makes the decisions about where the income is distributed. So the trustee will pay that tax. And then the beneficiaries will still receive income that flows through, but they'll get a credit for the tax paid by the trustee. Now,
does that mean they're double dipping on the trust then, Jono?
Well, this is where it's a little bit unclear, but what I think is the trust will pay its tax, and then the beneficiary, the person who receives the income, will get a credit for the tax paid by the trust. But the important point is the credit will be non-refundable. That means it can only reduce their tax payable to zero. It can't result in a refund. Say if there's someone who, again, we'll go through in the example, but if there's someone who has no other taxable income and they receive a trust distribution that has tax credits attached to it, this sounds like it's going to prevent them from receiving a refund, even if their tax is less than the tax they should have paid on that distribution.
So overall, the trusts are less effective. That's the headline, isn't it?
That's the bottom line. Yep.
Yeah, right.
I think that's the idea. They're trying to, they've talked about entity taxation of trusts in the past, taxing them like they're their own entity rather than this pass-through vehicle. This is basically implementing that in full, and makes it less tax efficient.
So for my family setup, Bloxy was recommending we set up a trust and we didn't get around to it now. Would you still set up trusts today in these family setups and inheritances? And when is it now? Is it not a good idea as much anymore? When would you now set up a trust?
I'd say it's mostly now going to be what's called testamentary trusts. So trusts created by wills. It mentions in the budget that these rules won't apply to those types of trusts. So they still might be valid types of trusts that are created by wills. So when someone passes away, the assets goes into the testamentary trust for the benefit of their kids. That's probably still viable. But in terms of family discretionary trusts, I'd say it's probably not as worth it anymore, and you'd probably more strongly consider the family investment company might become the vehicle of choice.
So talk to us a bit more about that one. Phil, do you want to take that or do we stay on Jono here? I feel like Jono's just copping all the questions.
Yeah, that's fine.
Jump in, mate, if you want.
No, just keep going. I'll jump in when I can.
Yeah, well, I suppose the thinking there would be, okay, the trust is going to get taxed at 30% minimum.
Yeah.
A company that only does investment, not business, will also get taxed at 30%. But you'll have the benefit of being able to retain profits in that entity. There's also less complexity around companies. There's already a whole bunch of tax rules that were changed in the past 2 to 3 years, to stop families from distributing to children and then they never actually receive the money. It goes to the parents, or it stays in the trust and just gets reinvested. There is already a whole bunch of anti-avoidance rules to stop people using trusts, maybe taking too much of a tax advantage out of it. But this will just completely kill it. So that's why I think the company would be more efficient. We can retain profits in it. We can use different types of shares in that company so that the right people in the family have the control. Some might be able to get dividend shares so they can get a dividend.
Yeah, I mean, look, to add to what Jono is saying, for tax purposes, I believe trusts no longer, if this goes ahead, no longer is the option. It's definitely a company. The reason being is because if you are holding investments either in a trust now or in a company, the tax rate's the same, right? But the difference is with a company, those tax paid turns into franking credits, which you can stream in the future.
Yeah, another thing that you guys are advising me on and got me doing.
Yeah, exactly. So look,
I reckon I'm the best ad for you guys, Phil, because I'm using all your tricks.
Exactly. Well, with all these changes, and it's said in the budget, they're providing relief for those that currently have a trust structure to roll over into either a fixed trust or company. So they're really pushing it, or trying to push everyone into a company structure. But I think at this point, that probably is the best structure now moving forward.
Do you want to run us through the scenarios before we've got a couple of questions on trust.
Let's get that example up.
All right, let's go. Jono, we're back to the share screen.
Okay, cool. All right, so these examples show a, sorry, mate. So this shows a trading company. So what I was talking about before. So having a trading company that pays its company tax of, let's say it had 100 grand of profit, and then it pays its 25% tax. It then pays a dividend to the trust, and then there's a distribution going out to an individual. So that's the big picture. And these are the numbers on different scenarios. So if someone is receiving that trust distribution of 100,000, so 75 plus the $25,000 franking credit, the company pays its tax at this level. We then go to the trust. Now this is the current law. So under the current law, the trust has income of 100, but there's no tax to pay because it's a pass-through entity. It then distributes this income to an individual. They've got no other income. So they have taxable income of 100,000, tax on that income of 22, but they get a refund of the franking credit, the 25,000 that was paid by the company. As Bloxy used to say, companies don't pay tax. So that's where we see that scenario. Now, under the proposed law, same thing at the company level. Now, what happens at the trust level is you'll have 100,000 of income, tax of 30%, 30,000 that the trust will be taxed on. Now we're assuming this one here. We're assuming that they will get a credit for the tax already paid by the company. That's subject to final law. And then they'll have to pay the difference. So they'll pay another 5 grand at the trust level. Okay. And then if we look at the individual, this is where the difference comes in. So they're going to have the same taxable income, tax on that at 22, but then they're only going to get a credit equal to their tax of 22. So they are going to miss out on the refund cash of 2,748, and they're going to waste some credits of 7,748. So if I just go down here, the impact on the individual total income,
$10,000.
$10,000.
Yeah. Now,
So that's where
John,
we see. Yeah.
John, sorry, I'll just go back up. I think probably another disclaimer for the listeners there is we're not 100% sure on how the franking credits from the tax paid by the company will be passed through. If it goes to the trust level, does that $25,000 franking credit act as a credit against the so I guess the question is, that $25,000 that's paid by the company, do we actually get that do we actually get that refunded, Jono? Because that was paid by the company.
Right? The 25.
Yeah. So my thoughts maybe, and once again, we don't have enough detail. That's why we're making assumptions here. But the $25,000 should come off the 2.2, perhaps, the $22,000. And so realistically, they would be getting a refund of $2, but they're $2,748 still. But then they waste $5,000 of trustee tax credits.
Yeah, possibly.
So that could be the alternate scenario as well. Okay.
Yep.
Ultimately, in this proposed law, the low income earner here would be paying more tax, and that's the whole point of this law, so that the government can reduce the income splitting to reduce the overall tax payable by the family group.
Yep. And to that point, Phil, good point. I don't know if I can share on my screen just what it says in the budget papers, but basically it says, can you see that? So They say that the government will consult with stakeholders on key details of this policy, including the mechanism for collecting the minimum tax of trust, how trustees use franking credits. So this is the unknown. They say they're going to consult on that and work out what to do.
Yeah, I got an idea for them. Don't do it.
That'd be nice. Yeah, that'd be nice.
All right, we got a few more comments. Paul Trina, I can see your comment and question. We're going to answer that one at the end. So, Paul, hang around, and we will. The solvers will do their best to answer that one.
Okay.
All right. Anything else on the discretionary trust, or are we going to bump into the negative gearing?
That's probably enough on the trust, I reckon.
All right. Well, Belinda actually asks, if someone owns an investment property inside a discretionary trust right now, what things should they be reviewing before these changes come into effect? So how should you be thinking about it?
Well, I'd be looking at the value of the property and whether that is still an asset you want to hold. Obviously, because if we're selling it pre 1 July 27, you're going to get full CGT discount and avoid this 30% minimum via the trust.
But you're also accounting for the fact, what if all the property prices drop, Jono? So
yeah, well, that's true.
That's another problem, isn't it? And that's the volatility that they've gone and created.
That's the market risk. Yes, that's right. I mean, the other thing I'd be looking at is the trust deed and what it says about vesting the trust or winding up the trust, just to see if if it came to it, could you restructure the asset so that it was held in the right structure for your family going forward. So maybe that it, like some trusts or a lot of trusts, have a company trustee and a corporate trustee, we also call it, and that could be used as the holding structure. But then again, moving things around, we also have to be careful of state taxes. There's stamp duty on moving properties around. So it depends where that property is, in what state jurisdiction. The federal government say they're going to have all over rules, but how do we know what the states are going to do?
Yep. All right. Next question we've got from Andrew Wilkner is, thank you guys for jumping on this. If you're moving from a family trust with 4 beneficiaries to a company, what will the taxable event be? 1, and 2, are the shareholdings fixed?
Yep. Great question. Well, what would the taxable event be? Anytime we move assets, there's potential capital gains tax. But what we'd be looking for is some rollover rules to move from one structure to another. There's a whole bunch of existing rollovers that allow you to move assets from a trust to a company, which we could look into. And as it says in the budget, there might be some special rollover rules that are available to us on top of what's already there. So you'd be looking to get into those so that there's no capital gains tax. And are the shareholdings fixed? It depends on the company. We need to be careful on. So you've got different classes of shares within a company, but ordinary shares have rights to dividends, voting, and capital when the company's wound up. So those shares are fixed. There are other types of shares, such as dividend-only shares, that can be used to only pay dividends on those shares when you wish. So that's probably what you'd be looking at. So yes, it's mostly fixed, but there are some options with the shares that you issue in that company.
Just adding on to Jono's answer, in terms of Andrew's question, if it was to occur from 1 July 2027, the move from family trust to a company, it's in the budget. They are allowing restructuring from discretionary trusts into companies or fixed trusts. So, and it's a 3-year rollover relief. There's no details around that specifically, but I suspect it's going to be relief for any capital gain tax event and any income tax event as well.
Guys, one thing I'm just hearing is there's a whole bunch of complexity around this that we just weren't quite ready for. You guys are particularly impressive at knowing these rules, I'm telling you. It's like it's been out for 24 hours, you're good. So if you want to use the solvers, guys, the link is in the comments. You can book a meeting. Let me do my sales pitch for you, Phil. You're too modest. I'm doing my sales pitch for you. So, yeah, if you want to get in and have these guys help you, they help me out. They're absolute legends. All right. We've got a couple of questions around negative gearing. Mitch White, I can see your question. We will definitely answer that one as well. Yeah, Jono, you start us off. Negative gearing. What are the changes? What's the deal?
Negative gearing. Oh, Phil, do you want to take this one?
Yeah, I'll go through that one.
Phil, yes.
Yeah,
I'll do the nice and easy one. I wanted to give Jono all the shine. He's never on camera, so. Look, in terms of the negative gearing changes now, I think there's been a lot of talk about it on the news, and it was kind of headlining the budget before it was released. The reason why we're talking about this now is because the other two we feel is more important for our clients and the Australian public. But in terms of negative gearing, now the proposed change is that negative gearing is only now or limited to residential properties that are new builds only, and it applies from 1 July 2027. Now, investors, if you don't know what negative gearing is it's when there's more expenses than income for the property, the rental property, and then you could use that to offset your personal taxable income. So they're not allowing that anymore for existing properties. Now,
what's for new purchased existing properties? Is that right, Phil?
Correct. Purchasing new builds only. So it's got to be a newly built property.
So I can still do it for my old one.
Correct. So if you currently hold a property that's negatively geared prior to this date, you can still claim those losses. So it doesn't really affect anyone that already has that rental property that's negatively geared, but it only affects those moving forward looking to buy into an investment property. So, a lot of investors now would definitely be looking at buying or be turning more towards new builds versus existing properties. Okay. What it excludes, and this is important, is that it's not changing for if you're purchasing commercial property. So maybe with this change, you may see more investment into the commercial space. Shares and investment portfolios. So if you've got a big balance or value of shares, for example, you could get a margin loan against it. And then obviously your expenses relating to the share trading. If it exceeds your dividend income from those shares, then you can claim those losses as well.
So that's Mitch White's question here. So Mitch White asks, is it true that assets outside of property, such as shares, are exempt from the changes to negative gearing, so shares can still be negative geared?
Yeah.
So the answer to that is,
Yeah.
the answer is yes.
So now, I guess, going back to negative gearing, the other change is the carry forward losses. So because you've got, if you decide to buy an existing property post 1 July 2027, and there are losses in that property, those losses are now trapped in your personal name or whichever entity you hold it under. Let's just assume it's individual. It'll be trapped and it will be carried forward. So you won't be able to offset it against your current year income, but you'll be able to carry that forward to offset, and this is per the budget, future rental income. So once you turn a profit, or future capital gains from the sale of that residential property. So that's something new there, to offset capital gains on the sale. So it's not the end of the world, I think, in terms of this change itself. I think it was kind of played out like it was a massive change and it was going to affect so many people. But overall, when we actually look into the meat of it all, I don't think it's that bad. Okay. Jonathan, did you have any comments on it?
Yeah, I mean, Dave, you were asking about the market before, like allowing a rule for one type of asset, but not for others. So if you're still able to get negative gearing for new builds. Well, I just wonder what that's going to do to the market for new builds versus existing properties. And, you've experienced it yourself with trying to sell a property. People are maybe seeing less value in buying those maybe unit investments and existing properties where they're expecting most of the return to come from capital gains rather than the rental return. So I think this will distort the market a little bit. I think that this one will have impacts on the property market. In terms of the complexity, this is probably from a tax change point of view, is that probably the simplest one compared to the other
Certainly
two.
the simplest to understand, isn't it, Jono? But the impacts of it might be far more reaching, because if I buy a new property and I can negatively gear it, that doesn't mean that the next person who buys it off me can negatively gear it. And so therefore the value of that when I resell it is not going to be as high. So therefore the property values of these new buildings are maybe not as valuable. That's my big fear.
Yeah, and then you'll get taxed at almost 40 or anywhere between 30 to 47% on the sale, Davo.
Yeah, so I just don't think it's going to help the new properties at all.
It's as I said, it's deterring people to invest, all these changes.
Yep.
All right, well, let's go through a few of these. Anything else on negative gearing, and we'll get to some of these outside of the questions. I'll entertain you. Scotty McLaren says, this government is part of the reason I moved to South Korea. So for those that don't know, Scotty is a regular commenter on my show, and we always tease him about being in South Korea. And so it's quite funny. Cecil, g'day, Cecil. You will own nothing, and you better be happy about it. Goodness me. I guess the thing is also... I think also, guys, like whilst we may be joking around these comments, I think understanding the sentiment that is towards this is important to keep a track of, because if the government flip-flops, then you can see what might be coming. And so actually having a handle on the sentiment. Politeness Man says, we are prosecuting Coles for lying to the public. Our government gets to lie to us with zero consequences. Oh, goodness me. All right, I think that's all of the personal commentary. So we'll get into some more of these questions. All right, so Paul Trin asks, I am trading crypto futures and withdrawing my profit into my business. Do I only pay the 25% tax for my business, or do I have to pay an additional capital gains tax on top? Geez, that's a good question.
If what you're doing with the crypto futures is more like a business, potentially there wouldn't be capital gains tax per se. It'd be taxed more like a business. Now, if you're carrying on a business as a sole trader, you're going to pay tax on your profits at your marginal rate. And then withdrawing profit into the business, well then, I mean, that sounds like if you're putting the profit into a company, if you've made the profit in your personal name, pay tax on it, and then put it into a company, well, I don't think there's tax on the second part. I think there's tax for the sole trader. But maybe a better question is, why not do the whole thing under the one company? That might be the way forward. That might be an option to simplify it for you.
Feel like I could see you champing at the bit. Have you got something extra?
Now, if you're running a business here and you're a trader running the business, the trades and the profits on the trade is treated as revenue and profits, right? And it's not capital in nature, so therefore you'd cap it at that 25% company tax rate.
All right, MGR 001. Should have been 007, manager. Is a company structure now the best way to hold property, even allowing for the non-indexation of the cost base? Is a company structure now the best way to hold property, even allowing for the non-indexation of the cost base?
Look, it depends on what you're doing here. I think it can be, but I think the individual itself is still the best way to hold property if it's your main residence for investment purposes and to grow value. But if you've got that already and you're looking to invest in the future to build more property, to buy more property, then I suspect company is probably the way to go there. Jono, do you agree or disagree?
Yeah, I'd agree with that. If it's long-term investment, the main play is income rather than the ultimate capital. Obviously, you want to build your wealth and your asset portfolio. The only question there would be lending, but typically companies are generally okay for lenders. I know trusts, sometimes they have a bit more complexity with them, and banks tend not to like them. So I think company is still viable. And also from it's not just capital gains and income tax for property, it's also land tax. And in most state jurisdictions, you do get a threshold for having a company, whereas particularly in New South Wales, you don't get a threshold with a discretionary trust. So that's where a company structure does make sense for property.
Paul Trent has answered a question. It's all under the company. Nothing is personal in my name. So that's just following up from Paul's comment that he's trading crypto futures and withdrawing profit into the business. Does he only pay 25% tax for my business, or do I have additional CGT on top? He's saying it's all under the company.
All under the company. Yep. Well, then it's what Phil said. It's the 25% on the profits.
All right. Anything else, fellas? Before I answer we're going to answer the last question last, guys. If you can see those comments.
Yeah, good one, is it?
Yeah, it's a good one. It's a good one. What's your take on it, Phil? Generally, how should people be approaching this? Is cautious, curious? Are those the two key words that you would advise people to take here?
Yes, I would be. And the third tip would be definitely reach out and speak to your accountant about all these changes and make sure that, I think the first question that you had around the property and the discretionary trust, one of the other things that person should be doing is speaking to their accountant to work out scenarios as to, if I hold on to this for another 10 years, what does that look like? If I sell it now, what does that look like? Just running scenarios around the changes on your situation will just help you will give you clarity and help you make a better decision. But once again, I'd say also there's not enough information yet. If you hate these proposed changes, keep kicking a storm about it, and let's hope they can make some amendments or repeal some of them.
Also, the other piece of advice I will maybe ask, is the AI tools that are now available. I use them pretty thoroughly before I chat to you guys about, talking through these things. Can they be trusted? Can you use them? I know it's a different question. Without notice. Does that help when David Boulderman turns up to a meeting with John O'Wilkes and he's gone and researched all this stuff and done a bit of work in advance rather than just turning up with nothing?
Oh, it depends.
I think that's actually helpful. Sometimes, it's helpful for us when clients and people we meet have done a bit of their own thinking and they're almost directing, well, what about this or what about that? I want specific advice on that. So I think it's helpful to a point. Obviously, you still want to get stuff validated and before doing anything in the real world, you probably want to get some advice. And yeah, whenever you're dealing with the ATO, it's best to be
100% sure.
And it's best to have all your ducks in a row.
Correct. A useful tool for general exploratory knowledge, just like Dr. Google, but you still go to the doctor. We'll take this comment this will be our second last comment from MGR001. Is this the end of testamentary discretionary trusts?
From my reading, I don't believe so, because it sounds like they would probably be carved out of the trust changes.
It's only the family trust that's caught on these proposed changes, and the whole purpose is just to have the family group pay more tax.
And
then One Disciple Michael, the last comment. Will these changes push the Sharks into a recession? What does these changes mean for the Sharks? Well, I'll just start with you, Michael, and say the Sharks never change bloody anything if you go watch the starting lineup. But funnily enough, the Sharks also sold off all of their assets, didn't they, Phil? So maybe they were better off to get out of those before they had to go into all of that rubbish and trouble. I don't think this is going to affect the Sharks. Is there anything for those? Business like
looking at their financial statements, or the current ones, I don't think it's going to put them into a recession. I do believe we're one of the more successful clubs now financially, and with the club opening, is it opening soon? When's it opening?
Yeah, it's opening soon.
Yeah, when that opens,
round 27, Phil, is what I'm told, but I'll believe it when I see it.
Look, I think when that opens, we'll definitely be in a lot better position. We're already in a better position than where we were 10, 15 years ago when they were talking about winding us up. So,
yeah, well, if they're ever going to wind us up, Phil and Jono will get in there and save the day before any of that stuff happens. Guys, thank you for that session. If you are new to watching Solve Accounting content, do hit the subscribe button on the YouTube page. That way you get notified of everything they've got coming up. We try to solve a whole bunch of questions with the guys at Solve Accounting. So they're particularly helpful for helping me. I'm certainly an advocate for their business, and they're a bunch of nice guys too. And we don't hold it against Jono that he doesn't really support the Sharks. We don't like to talk about that too much.
He's in the Shire.
Any final commentaries, fellas? Are we happy to wrap that up and say thank you to everybody? Thanks, MGR, for that great comment.
Everyone and taking time out to pose questions to us and to listen to us. I'm hoping that you guys have gotten some value out of this. So thank you.
And any suggestions on what we do in the future, also get that into the comments as well. I'm going to help the Solve guys. So, yeah, I host a rugby league program and also a science channel. So I'm doing a bit more finance is a good fun idea. Jono, thanks, mate. Good to see you.
Thanks, Dave. Appreciate it.
All right, guys, we'll see you next time on for Solve Accounting. And for me, David Boulderman, I hope you can work out the budget. See you guys.
Thank you. Cheers.